again. How are we all doing? So, a bit late this morning, aren't we? Overran a little bit there, talking about brokers. Love brokers. Love talking about brokers. People don't understand what's going on in this industry. The whole thing is just completely geared to make you fail. And there is no friend. Even the friends you have are not your friends in this industry. Morning, Danny. Morning, Linus. Here on time. No, 2 times me. That's good. Morning, Evil, Vitali, Jules, Noob, FTNet. Funny how naive people are. I used to be naive. It's nobody's. The thing with education and learning stuff is you are naive to everything until you've learned it. And when you learn something, I think the thing with this industry that differs from most is when you learn something in this industry, you tend to disbelieve it. Which is, again, understandable until it's been proved to you. And the problem with this industry is there's not a lot you can really prove, is there? Because it's an incredibly complex thing. The whole stop, the biggest conspiracy in this industry, I think, is the stop run. It's like that. Great example, yeah? Oh, look at that candle. That was them running the retail stops. No, it wasn't them running the retail stops. It's just where price pushed down to before it pushed away, because it pushed away last time. There's a load of orders sitting here. If that was the case, why didn't they go down here below that low? Because if they were running stops, they would have done that, wouldn't they? They're already here. They might as well just go down a little bit more. It's just not true. When you talk to someone in a bank about this sort of theory, like my mate Dave, it's weird. Somebody said to me, is it the man from the Bank of Dave? No, it's not the man from Bank of Dave. His name just happens to be David. He used to work in a bank in the forex desk, and that's it. That's the only thing. His name's Dave. But, when I've spoken to him about these theories, and he knows all about these theories because he spent a lot of time in the retail world as well, obviously trading himself, and he looks at the stuff on YouTube, and it's like he can't comprehend how people come up with these things. And when I explain to him it's because they're selling something, he's like, oh, it makes total sense, doesn't it? You can find order and logic in chaos everywhere. Yeah, every chart you can give a reason to that, but the reason is it's literally just a volume of orders being bigger than another volume of orders. That's it. But you can make a conspiracy or a course around that because it happens often. And that's literally all everything is. The stop run is just a order being placed at this area, which is where it was placed before. It's just not the same price point. That's all it is. That's not the same price point as that. That's not a stop run. It's just an order went in big there. There was no more order left. So there was no more up. That's all that's happening. But I've got into so many arguments with people about it, and you just end up giving up. Anyway, I had an accident with my first broker where I could no longer close positions. The support experience was eye-opening. Since then, I know how things work. What is important to me is what to look out for. Yeah. So basically, when you're choosing a broker, you literally choose a big one. Yeah. That's it. So if there's a broker that's been around for 10 to 15 years, IG, IC Markets, FXCM, DarwinX, RoboForex, yeah, that is the best you can do, because none of them are in it for you. They're all in it for them. And you just got to pick a biggie. Yeah, you've got more chance of surviving and getting the support and the backup you need with a big broker than you have with a little one that's in the middle of the Seychelles that's got 10 customers. Regulated, tick. Big, tick. If they sponsor a football team or a rugby team or a Formula One team, tick. Yeah, because it means they've got a shed load of money. If they've got a shed load of money, they're not likely to disappear. I thought that with Alpari. Alpari, biggest broker in the UK, went bust when the Swiss franc peg was removed. I thought I was safe with Alpari. The reason I went with them, because they're the biggest broker in the country. They disappeared. They're still there, but not Alpari UK, Alpari worldwide. And again, they've all got departments and offices all around the world because they need to offer regulation and flexibility to everybody around the world. If you can't get what you want in the UK, don't worry, our Singapore branch will sort you out. If you can't do it there, don't worry, our New Zealand branch will sort you out. If you can't do it there, don't worry, our Cayman Islands branch will sort you out, because there's different regulation and different laws everywhere, and everything's electronic. It's all smoke and mirrors, the whole thing. You have access to the market, you can press buttons. That's it. Don't worry about it. Anyway, we're on the wrong subject. It became profitable when I started position trading. However, people I know call me crazy for not using a stop. Yeah, but they're all loose in their moves. This is the thing. Again, I have this argument and conversation with people all the time. You're stupid because you don't use a stop loss. How are you going to stop out of that trade when I decide? Yeah, but you're not controlling your risk. Yeah, I am. I'm happy in the risk I'm in. If I'm not, I shut it. That's it. Well, you were not going to be able to do that. I do. I can't argue with you anymore because you're an idiot. Because you're sitting there telling me that using stop loss is better. However, your bank account P&L looks like that. Mine looks like that. But it's going up, not down. Yeah? Who's right? Banks and institutions use DCA to enter positions into the market. DCA, dollar cost averaging, position trading. Exactly what you see on the chart here, making loads of money. I don't know. I don't know what else to say, how else to prove it to people. But, you know, Holy Grail. It's out there somewhere. Right, so speaking of the Holy Grail, Phil, you're not in here, are you? I will try and find that video as well. You in here? Phil's not in here. Anyway, so Phil's come up with a strategy. So today we're going to look at daily trading strategies and any strategies that work on the daily time frame. Morning, Mark. So trading daily is basically what the banks and institutions do. Yeah. It's just the bread and butter. So when you're trading intraday on 5-minute time frame, for example, let me just go over to my other platform because it will make more sense because you can see the times. So when you're trading a 5-minute time frame, you're trading order flow. You're trading intraday. You're trading all the chop. Yeah, this is basically bank orders going in loads of different directions, and it's completely random, as we know. Yeah, so they have a volume of orders to execute on that. They've got a volume of orders to execute on that, and throughout the day, yes, here, but also doing a drone survey. Okay, Phil, good multitasking. So yeah, basically they're executing orders up and down. So with intraday price action, every single day is different. Yeah, it's totally random. So it will go up, go down, go up, go down, go up, go down, and the wicks will be different sizes. News will affect it. It will spike up, it will spike down. Some days will be bull, some days will be bear, and how it gets there is going to be different every day. You might have that happening. Yeah, so trying to make sense and place a repeating system onto this type of movement. There's a beautiful example of what I was talking about. Yeah, price didn't get there. Right? The candle was there. Why did you execute my order there? Because you asked us to give you a break even, and we spread the market there to give you what you asked for. Thank you, Mr. Broker, for stopping me out before price got to the price level. Sorry, you signed a contract. Perfect example. But anyway, intraday. And intraday, this is what happens intraday. It's moving around all the time. So trying to apply a system or strategy to something that has so much randomness is very hard to do with a stop loss or without a stop loss. And every intraday time frame has exactly the same problem. However, on intraday time frames, you see the same things playing out on all time frames, price action. So when you get a whacking great wick to the upside that can't sustain that move and ends looking like that, it means that the bears have taken control or the bulls have run out of steam. Therefore, there's a chance it's going to come down over the next X number of candles. The advantage of moving up to a daily time frame is the power of these signals is so much bigger, because you are seeing a much larger volume of orders. You're seeing on that one candlestick approximately $7 trillion worth of orders. On this candlestick, you're seeing a couple of million, maybe 100 million, I don't know, but a tiny portion of what the real story is today. Yeah, so when you go up to the higher time frames, 4 hour, but specifically daily, you've smoothed out everything intraday that is random, is chop. Yeah, so when a candlestick on a daily time frame ends bull, yeah, we are 100% sure that day there are way more buyers in this market than there are sellers, which gives you a higher probability of something like that continuing to play out. So bullish engulfings, bearish engulfings, that sort of thing, price action candlestick patterns, 3-bar reversals tend to have more weight on higher time frames. So developing strategies on higher time frames tends to give you a higher strike rate. So you tend to have more quality signals. So when you see anything playing out on a high time frame, like trends, for example, there's more chance of them continuing, and there's less chance of you getting stopped out on the position or the trade idea being invalidated, because there is no intraday movement to worry about. Yeah. So daily time frames are what you tend to find institutional traders trading. Yeah. So all the big names in trading that you've heard of probably in the past, Ralph Elliott, all the big names. I'm trying to think of the big names and I can't reel any off my head. But Larry Connors, the Turtles, those, the guys that make a load of money, Warren Buffett. Yeah. They're not interested in anything that is intraday. They're interested in what is the market doing right now. Yeah. So this is the time frame where the real money is made, and this is the time frame where the orders are executed. So double tops, things like that, incredibly reliable a lot of the time. But more importantly, when you get into these positions, if they work out, the hold time on them and the distance that you can get out of them is substantially bigger. So they work well with risk reward based strategies, but they also work incredibly well with position trading strategies, because there are characteristics you'll find on weekly movement that play out that you can benefit from with daily timeframes. Yeah. So things like multi-day pushes. If you get 3 to 5 rally days in a row, it's unusual for it not to have some kind of pullback unless there's a fundamental on it. On an intraday time frame on the hourly, that will happen every day on something, but happening on a daily time frame is very rare. RSI extensions, market movement, this here we're looking at is a month's worth of movement in one go. If it moves from a low to a high for an entire month, when you get the RSI extension, the probabilities of a pullback are substantially higher. So any signal that a condition indicator gives you on a higher time frame is typically going to be a lot stronger. So they are an incredibly good time frame to trade. But the downside to them is you're not going to get many trades. So most people that trade daily timeframes, investments, pension funds, hedge funds, all these sorts of investment type vehicles that you have out there that are returning 10 to 20% a year on average, they're using these timeframes to build a portfolio of conditions that repeat themselves and then just basically bank over a long period of time. So your hold time is going to be not days, it's going to be weeks and months. So the downside is you're not going to make a fortune, but you will find that your strike rate will be incredibly high because you can let the market breathe for days without taking a huge hit on your account. And then you have lots and lots of time to trade. So that you can look at this once a day. So you get home from work in the evening, you open up your terminal, you sit there watching the telly with your wife for half an hour and scan through the charts. Shut it. That's it. That's trading. Your trading life is now 10, 15, 20, 30 minutes a day. Very, very, very simple. Open up the charts. Have we got anything that's extended on the RSI? So you could use the dashboard for this. Have we got anything on the daily time frame extended on the RSI? No, shut it. I'll have a look tomorrow. It becomes incredibly simple to make decisions. But the price action that you see is the same. The candlestick stories are the same. So a indecision candle is an indecision candle on the daily. It's also an indecision candle on the 4-hourly, the hourly, and every other time frame you look at. A bullish and a bearish engulfing is the same on the daily time frame as it is on the others. But the amount of effort it took to get that 3-bar reversal in is way more than it is on a 5-minute time frame or a 30-minute or a 1-hour time frame. On a 1-hour time frame, price can make signals by accident. It's just that today we're going to do this all day long. Yeah, on a 15-minute time frame, all day long, you might find 3 or 4 3-bar reversal patterns. But the market is actually painting indecision today. But you're seeing chop. So you're seeing signals given to you that aren't actually signals. They're just irrelevant rubbish. So there's a lot of strategies that use moving averages, and there's a lot of strategies that use oscillators on daily time frames. And as I said, I've got EAs built that have there's a number of strategies out there that are very well known and work to this day that were invented in the 30s. But they work normally on stock indices because forex wasn't a thing when trading was at its peak in the 30s and 40s, when the stock market was crashing and rallying and all this sort of stuff. So a lot of the stuff you see is based on stock movement. RSI is originally a stock indicator. The overbought and oversold terminology is nothing to do with forex. You cannot overbuy and oversell an exchange rate. You can overbuy and oversell a stock because it's got an intrinsic value. The stock price of the company exceeds the value of the company. They've overbought it. Therefore, it comes down. And this is where this terminology comes from. People that run forex trading courses that tell you to look for overbought and oversold conditions, they don't even understand what they're talking about. There's no such thing. It's not a tangible product. It's not a tangible asset. It's an exchange rate. You can't overbuy it. Yeah, it can go up there and it can stay there indefinitely. If the fundamentals shift, it will do that. Yeah, you won't find that very often on a stock because when that stock is overpriced, no one's going to buy any stock. That's why it works. Yeah, but an oscillator is showing you price movement. So using this type of thing is incredibly powerful. Bollinger Band extensions also are quite good on some instruments, not so much on forex, but on stocks they tend to work very well because they're also showing overbought and oversold markets, so or conditions. So as you can see, when you look at a daily chart, the market spends 80% of its time in mean reversion. Yeah, it will trend sometimes, but the vast majority of instruments you see spend, that one's more of a trend, that's a Swiss, yeah, Swiss and yen are trenders. So most of the instruments you'll see spend most of their time doing this. So most strategies that run on the daily time frame tend to be mean reversion based. So using oscillators obviously is the obvious mean reversion strategy. There are also a lot of strategies that scalp daily timeframes, and the one that Phil has come up with is an example of that, which is why we'll look at that one today, because it's a good intraday strategy, but it's not, it's a daily strategy. So you're using the fact that on the higher time frames you are going to get a result, on the lower time frames you're going to get chop. If it's going to chop around intraday, you wait for something to happen on the daily time frame and then you use the intraday to exit your position. It doesn't matter where the next daily candle ends. Yeah, they also work very well for position trading methodology, because on the daily time frame you are not scaling in close together, and this is the problem with position trading. A lot of people put their entries far too close together. If you're only making a decision once a day, it's very hard for you to get it wrong. Because if you are spacing your entries 3/4 of an ADR or an ADR apart, And the intraday price action does this. What happens is you take one trade and you don't take another one. So it slows everything down. For people that have problems with over trading, the easiest way to stop yourself over trading is just to move up a time frame. All of a sudden, you've got now not 24 candles in a day, you've jumped up to the 4-hour time frame, so now you've got 6 candles in a day. It's hard to overtrade when you get 6 things to look at and 24 things to look at. Go down below the hourly time frame, hundreds of candles. There's 100 decisions you can make there. Daily, 1. So it slows everything down and it becomes more profitable as a result, because you're not over trading, and over trading is where it all tends to go wrong with most systems and strategies. They are good in certain market conditions. In bad market conditions, for example, a trend strategy, when it does this, a trend strategy will die. Yeah. A mean reversion strategy will kill it. So as I say, mean reversion strategies on daily time frames tend to be very, very good, because this is what it does most of the time. Yeah. And if it is starting to trend, it's going to do that. So you want to be mean reversion trading. So I will dig out the other daily strategies that I had. The main ones are Steve Carell's NR4 and NR7. Which is basically a breakout strategy. So again, there's 3 types of strategy. There's still 3 types of strategy on daily time frames. So the narrow range bar 7 and 4 is one. I'll find it and go through it. The RSI2 strategy, mainly for stocks, does work on FX as well, but you have to do it on the daily time frame. Position Trader EA doesn't do that, unfortunately, so that works incredibly well. RSI2, so if you look at an RSI2, what you're basically doing, and it's very similar to what Philip's strategy does with the RSI2 strategy, it moves up and down very, very quickly on the RSI, which is basically designating intraday price action movement up and down, but you're only looking at it once a day. Yeah, so that one is a good one. Normal position trading. So if we look at the Position Trader EA, that's 1.64. This is a development version. I need 163. So I'll need to do this on the 4-hour, but if we look at the RSI strategy, basically the normal RSI strategy that you would typically use. Let me just set it up. Daily, we'd need a 14 on the daily, something like that. We'll try 80-20. Might not get many trades with this one, but this is going to execute on the 4-hour time frame using the daily RSI. Might have the moving average entry wrong on this as well. We'll see what happens. But just to demonstrate the point, basically, yeah, I think it's, what the hell, that's getting in really tight. That's not right. So what I wanted to show was the amount of entries you get. Yeah, very few. So in total there we had 1, 2, 3 trades. Yeah, so this is what I mean by the downside to this type of trading is you are going to find it hard to probably want 1 ADR on that. You're going to find it hard to make a living doing daily strategies, but for long term, you can find multiple daily strategies that have an edge, and they're quite easy to find edges on, and just put a load of them together in a portfolio. And that's kind of what this day and tomorrow's about, is finding multiple strategies that are diverse, not doing the same thing. So a breakout strategy, a trend strategy, and a mean reversion strategy, and maybe a couple of variations of each, and put 6 of those strategies together that might only trigger 1 trade, maybe 2 trades a month. But if you've got 6 of them, there's an opportunity probably to trade at least once or twice a week. And they're all going to set up different. So if you've got a breakout one, yeah, you're not going to get a mean reversion signal on it. If you've got a trend one, you probably won't get a signal on it until the breakout one is complete. And then it might say, let's try it again on a trend basis. A mean reversion one, after the breakouts happened, you then might get a mean reversion signal. Yeah. So by having 3 different strategy types on the daily time frame, there's an opportunity usually on an instrument, if you're trading 28 of them, to find at least one entry on one of the 3 strategy types. So it's just about finding the ones that have the higher strike rate, but you want ones that have low entries, because you do not want it trading too often, because the more often you trade, the more likelihood of it going wrong is. So you want to pick the bigger extremes. So I'm just going to quickly change this to, where's my MA? 5. It's difficult to do with a position trader EA because I need to do it on the 4 hour. It'd be better to work this on the hourly, but we'll try it on the 4. So this is probably going to give similar entries. Yeah, so there's one there. I think we get one more, don't we? No, that was it. So this is over 4 years, not enough entries. So drop it down to 70-30, and it's just about finding the right sort of entry criteria. I'm just doing this as an example to just sort of demonstrate how many trades you're going to get, basically. There we go. That's taking trades too close together as well. See, the position trader EA, it's okay for it, but it's not the best in the world. But we'll stick an RSI on the chart on the daily, and I'll show you what I mean. Yeah, see, you don't take too much drawdown when you're using daily readings, because basically the market has to have done something quite substantial for a sustained period of time for you to actually get an entry, meaning that the signal is a much higher quality. So there you go. That's not set the world on fire. That's made 17% in 4 years. Yeah, it's not going to set the world on fire, but it's not taking many trades. So you can sit in these trades for longer with lower risk, because you know that the probabilities are higher, because you're trading a time frame which is higher, meaning that all the intraday movement is going to help you get out of the positions. You also have the advantage on daily time frame of fundamentals. The fundamentals are what drives the markets up and down. Intraday, you will have systems and strategies continuously stopped out or sent into parabolic drawdown because you are entering so quick intraday. Like Swiss yen, perfect example. Within 24 hours, yeah. I mean, 3 positions on this thing, yeah, because of a double ADR parabolic move. Yeah, it's playing out fairly nicely, and hopefully we'll get back down to here, and it'll be a nice little profit after 3 or 4 days. But when you look at this on a daily time frame, and you look at the number of times it does this type of move, yeah, we've just got a signal today to get in first entry. Yeah, but on lower time frames, you're just going to get in far too much just because of news, or because of parabolic movements on news. So it filters news out completely, and news becomes your friend, especially when you're only trading on a daily time frame where you're looking at intraday movement. So you're not looking at intraday movement. You look at the price there, and you look at the price there, and you look at the price there. The decision-making process is taken out intraday for you closing trades out as well too early. So when you get into a trade there long, you look at it there. You don't look at it there and every bear candle scares you out and you take a tiny profit, because you're looking at daily. So all the daily strategies that I have had developed over the past and looked at, they all only look once a day. So it uses candle close or candle open. Everything that happens in the day, irrelevant. We're not interested. So when you get a good move on long and you get an ADR hit in your direction, so say for example we'd taken a breakout trade here with the perfect NR4 strategy, 1 2 3 4, that would have been an NR4 breakout. Yeah, so you'd have taken a long position there. The next day it wouldn't have really done anything. The next day a 200 ADR move. Look at that. But look how much crap you had intraday to scare the crap out of you to get out of that trade. NR4 just took a 2-day 400 ADR profit. Yeah. The problem again with daily strategies is you have to use low risk, although there are ways of using high risk as well, but using low risk because you're needing to give the trades a lot of room to move around, because intraday movement is up, down, up, down, up, down, up, down, up, down, up, down. Yeah, so you've got to give it lots of room to move. There's no real tight stops with most intraday strategies, because you will get wicked out an awful lot. However, if you can get strategies like NR4, for example, always has a stop the opposite side, you're easily going to get 1-2 hour rewards out of these types of trades on daily time frames, but you're not going to get much more, because usually, like I say, trends are very, very hard to catch and very rare that you'll get on them. So if you're going to get onto a trend, it tends to be part of a breakout or a pullback, and the distance moved is months before you get a 2R out of them. Yeah, so there are some strategies that use stops which work very, very well on dailies, but typically position trading strategies and position trading methodologies, Larry Connors, all the guys that were in the Turtles, the RSI2 strategies, those sorts of things were all conducted on the daily time frame without stop losses. Yeah, so because you're getting in with a small risk, if it goes down against you, it's unlikely it's going to do any real damage. Yes, you're going to be in drawdown on it, but you've got 24 hours to have a think. Yeah, so it's really easy to trade. So that's an example of the RSI, of an RSI strategy on the daily time frame played out there. You can, that's Aussie CAD. Let's just try it on the pound US. But you know, everything is slowed down and works nicely with a lot less stress, if you like, and a lot less kind of risk. Yeah, but it will obviously all take an awful long time. Yeah, this one here is taking a long time, isn't it? That's going into quite a lot of drawdown. But again, spacing, position trader EA is not the best thing to use because the spacing, the way it triggers. Market reversal alerts EA is probably actually better to use for this. But, you know, it's, again, generated 5% a year. Yeah, so that's the sort of thing you're looking at, but you're going to put multiple ones of them together. So we'll look at Phil's strategy as well. How do the swap costs affect on the higher time frames? So swap costs are important, especially at the moment. Pre-COVID, swaps were not really much of a problem. Post-COVID, since the interest rate rallies, they've become a big problem. So when interest rates are low, swap rates are low. When interest rates are high, swap rates are high. If you're trading an interest rate that's low against a high one, the differential makes the swap extremely high. So with daily time frame trades, you're obviously going to be holding intra-week, intra-month. However, there are variations you can get out of on a daily basis, and we'll look at some of those when I've got the EA done properly before them. But end of day exits work incredibly well, or in profit exits work incredibly well with this type of strategy. And the one that I've got here with Phil's strategy uses exactly that. So this uses an end of day profit strategy. So we'll look at it in a minute, but yeah, swap costs, you're going to need to factor them in. But typically you would take lower risk with daily strategies, because the whole idea is you're going to use intraday movement to exit the moves. Yeah, so we're doing exactly the same thing as the banks do, where they profit take their moves. So we're just doing the same thing, but we're doing it on a much slower scale. So these are the things. The S&P strategy, just before I cover that one, the S&P strategy that I used to trade with the market reversal alerts EA worked on daily. And literally all I did, just shut that for a minute. All I did was buy the dips. Yeah. So I used RSI because this is what the market tends to do. I mean, the S&P at the moment, since COVID, this thing is not normal. This is not the same. But you literally just buy the dips, but you buy the dips and you keep buying the dips because you know what's coming. So you just keep buying the dips. So you take more drawdown, but you are assured of an exit. You're assured of a result. This is what Warren Buffett does. Yeah. Warren Buffett outperforms the S&P because if you buy the S&P at the beginning of the year and you sell the S&P at the end of the year, you'll typically make on average 8%. If you look back over the last 50 or so years of data, you will make on average 8% a year. Yeah. More than most pension funds will return. Yeah. Good job. And that's the goal, isn't it? To make more money. Warren Buffett increased that by literally just buying dips multiple times. So if you're going to make 8% a year by just buying it and selling it, if you bought it multiple times, if you bought it twice every time instead of once, you'd make 16% a year. If you bought it 3 times instead of once, you'd make 24% a year. Yeah. And so on and so forth. So the way that he incrementally increased the profitability of his firm was by multiple buying dips, because he knew that there was an edge in the fact that the S&P continues to go up. Unfortunately, in bear markets, that edge vanishes. Yeah. So it doesn't work. When COVID hit, which is there, yeah, we got the biggest rally we've ever seen, followed by the biggest dip we've ever seen. So even buying the dips here would have worked. You will always get an exit buying these dips, but the dips would have taken you into huge drawdown. But you are assured it will go up because the market can't crash forever, because it means all businesses in the US, top 500 businesses in the US, are all going bust. It's not going to happen, is it? Think about it. If 2 of the businesses in the S&P 500 go bust, they're replaced by 501 and 502. You've still got the S&P 500. If 2 go, 2 take their place. It will always do that. So a really good strategy on this is to just buy the dips. So you use RSI 2 or RSI 10 and just buy dips when you get RSI extensions to the downside. If I stick an RSI on there, it will make more sense. Where's RSI? RSI. Start off with a 10. That's a horrible RSI. Why can't I see the levels? And again, I've built this out as an EA. Mint cream. What on earth was I thinking with the color scheme on this? Yeah. So RSI 1030 entry. There was one there. There was one there. Yeah. So we're going to need a smaller one. Let's use the good old RSI 2. Yeah. So the RSI 2 entry basically is you buy it here. Can't see that one, but you buy it there. Might have bought it there. You buy it here. Yeah. And you see what I mean? When you go into a bear market, you then buy it here and then you scale in. Yeah. So the multiple entries become forex profits. But the reliability of the strategy is incrementally increased because you're trading that daily time frame. Yeah. So let's look at the one that Phil's come up with. But I'll get these EAs done. If you want to find good data, I'll tell you a couple of good sources for daily strategies. If you're familiar with Jared, the transparent trader on YouTube, yeah, probably know who he is. If you've probably seen his egghead. I should be nasty. I'm not being nasty. I'm just stating a fact. He's bald. But Jared does an awful lot of analysis of Larry Connor's work, and Larry Connors is a fantastic day trader in daily time frame trader. So a lot of his strategies and Steve Krabel's strategies work very, very well still to this day, because they are literally just range breakout and pullback strategies, but they're mostly designed for stocks. So you can always find those there. But I've built out all the models on those, and they all produce profit. However, they don't produce any more profit than my normal position trading on the 4-hour and the hourly timeframes does, which is why I don't use them, because I can actually generate more revenue and more profit by going down to slightly lower time frames, pretty much doing the same thing. Yeah. So, but I will look at those in a little bit more detail. With better quality, would this be okay for higher risk? So yes, you have higher risk opportunities as well. So the problem with risk is obviously when you get an unexpected thing happen, you will take a lot of drawdown. So the best thing to do is to use low risk and survive. So there's always that payoff with risk reward. So let me just run let me just run this with a standard lot for a year. Oh yeah, it's hourly, that's right. So this runs on the hourly time frame because it has to do something at a specific hour of the day, but it's using daily movement. Yeah. So this is running with a 0.1 lot size. Yeah. Which is fantastic. Look at it. It's a 50k account, and we're doubling the account in a year. Pretty much. Might take a while to go through. What have I got this on? Tick. Control points. Okay. So this is running a test over a year with one standard lot. But the lot sizes you're getting up to are going to be bigger, obviously, because it's a position trading strategy, the more that you do it. So there's two ways to look at daily trading strategies. One, you pick a few instruments with one strategy. Yeah. And make sure those instruments are diverse. So this is generating a lovely 100% revenue profit, which is nice over a year. It's massive. So this I would class as high risk, because if you apply this to 5 different or 6, 10 different instruments and you get a problem like that, that is tenfold enhanced, isn't it? Yeah. So if this suddenly took 20 grand's worth of drawdown, 20% drawdown, or that would be 40% drawdown because it's a 50k account, I think this is testing, and you ran that on 3 instruments, you've pretty much blown your account. So you're better off running multiple strategies or multiple instruments en masse with much lower risk, because that gives you more diversification. So if markets suddenly go like they did last year into a horrible range bound thing where you're just not moving anywhere, yeah, your range bound strategies are going to work really, really well. Your breakout ones are going to die. So are your trend ones. Your trend ones probably won't even trade. Yeah. So when you've got a mixed market where you're getting trends, you're getting breakouts, you're getting ranges, or you're trading multiple instruments, you're always going to get something new going on. So you're better off just using low risk and taking more trades. If you go with high risk, so let me just see what the drawdown was on that. 8. So I would say you probably got into 30 grand's worth of drawdown on that. Yeah, because that is closed drawdown, not open. So that probably took about a 30% drawdown. So if you suddenly think, okay, I'm going to up my risk to, let's go to 0.3 lots. Whoops. And run the test. Might not blow, but you might find this blows. Yeah. It's about surviving. Yeah. On the daily time frame as well. It's just everything's going to take a lot longer to play out. So, yeah, it's still killing it. That's producing less profit. How's that work out? Oh, 156. No, sorry, it's not. It's 3 times the profit. It's a 50k account, not a 100k account. So we're up to 170k now. Yeah. This is using fixed lot sizing as well, yeah? We're not using a percentage risk. We're not increasing our risk as we go. As our account is now growing to 180 grand, we're still using the same lot size. We're not increasing our risk. So if you increased risk percentage-wise with account growth, this thing's going to have an equity curve that kind of goes up like that, yeah? But it's not, because we're using a fixed risk to test robustness, basically. So yeah, there you go. So that took a 26k, so I'd increase that to probably something like 60. So it's 18% drawdown. So we're taking a lot more drawdown. This is a 50k account. If you went into that 60k drawdown, for example, on day one, you've blown the account. Yeah. Luckily, this had made 132 grand. So going into that sort of drawdown doesn't matter. But you can take more drawdown with these strategies, especially position trading style strategies. Because if it's wrong for many days on a row, you're going to take a lot longer to get out of them. The problem is, if you're taking lots of extra trades on other instruments, you're just exponentially increasing your risk that you've got on, but your drawdown isn't dropping very fast. With intraday trading, we're in and out of trades within days. So if you take more trades, some of them make profit. With daily candlesticks, it takes a lot longer for the profits to be achieved. So you can build up drawdown a lot bigger and quicker. Yeah, so, but how do I have hair after trading for 20 years? That's a good question. I don't know. I'll just show you, for those of you who don't know Jared, it's worth checking his channel out. Talking about people with no hair, yeah. He does make me laugh. He's very good. I love him because he is logical. He's also selling stuff, but he's logical. Everything he does is based on robustness testing. Everything he does. And he basically takes old strategies and tests them. And they're great. That is an egghead. Yeah, it is. It is, isn't it? I have nothing wrong with it. I think he's great. He's been training a long time as well. But yeah, we'll do some of the same strategy stuff that he does on daily time frame, basically. So just want to explain this strategy. Yeah. So we will watch it visually play out. So this particular strategy that Phil has come up with is it uses just one time frame, which is basically, or one time of day, which is 9 p.m. So let me just let it go. Oh, I'm on control points. I need to slow this down. Let me just put it onto tick. Let me pick a different date. I've realized I'm not using a date period either. So bear me one sec. That's right. My wife's had to take the car in and just making sure that it wasn't her. So basically what this strategy does is there we go. So it at 9 p.m. UK time, my broker calling again, it might be, yeah. At 9 p.m. UK time, all the strategy does is analyze. We were talking about this level indicators yesterday. It analyzes the day's movement, yeah. And if it's a bear candle, all we do is we enter long at 9 p.m. And the logic behind it is that because we've pushed down, tomorrow we will probably unravel a percentage of that move before we take the next move. Yeah, so it's market structure based logic, which is correct. So if you look at the am I going to be able to find that indicator? Excuse me. I showed an indicator the other day, and I can't remember what it was called. I think it was that one. Yes. Let me just apply it to another chart. It's this indicator here. So basically this indicator here shows you the daily candlestick, or the daily candlestick basically on the lower time frame. So as you can see with daily candlesticks, you've always got the body, yeah, and as we know from price action, there's always wicks, yeah, and the light bits are the wicks. So it stands to reason, if the vast majority of candlesticks, and as you can see here, it's very rare you find what's called a strong closed candlestick where there isn't a wick. Yeah, there's always a wick. Yeah, because price does not open at a point, go straight in one direction, and then close at the point it closes at. Yeah, there's always intraday movement. So the logic behind the strategy is that you are always going to have some kind of intraday movement that is beyond where the open and close is going to be. Yeah, and that's what we're playing with here in this particular strategy, is the intraday movement. So what the strategy does is at 9 p.m. it looks at the candlestick. If it's bearish, it buys it. If it's bullish, it sells it. And all we're looking for is we're measuring the high of the day, in this case because it's a downward candlestick. And when we get in, we're measuring that distance, and we're looking for the market to retrace 38% of the move, a Fibonacci ratio. Yeah, so we're looking for it to pull back 1/3 of what it did that day, because the next candlestick is likely to have a wick. So if we are bear, the sellers are in control, there's a high probability the next day will be a bear move again, because the bears are in control. So there's a good chance that they will carry on being in control. If they make another bear candle, the probability is the bulls will try and push back before the bears win the battle. Yeah, so we get a pullback before a close, which means that we play the wick. Yeah, so that's what it's doing. So as you can see here, we've got a down day. That's where we entered. It's measured that distance and plotted a 38 retracement. And again, I've got the EA set up so I can try different retracements and do some further testing on it. But there you go. So we hit target. Yeah. The next day is bull. Yeah. So we get in at 9 p.m. We look at this day. We retrace 38% of it. And that's where we look to get out. Yeah. So let that one play out. Hit the target. Yeah. And so on and so forth. So next day we're down as a down day, enter there, looking for a 38 retracement. So all it's doing is using the fact that on a daily time frame we have a bias created, bearish or bullish. Intraday, the thing just goes mad and executes orders all day long, which means that price very rarely goes open, close. It goes like that. Yeah, there's all this stuff in intraday, which gives us those candlesticks. This is where the vast majority of the trading was conducted. These are the extremes. Think of a bell curve. We covered bell curves a little bit in strategy development week. Yeah. Yeah. 60% to 68% of trading will happen within here, and statistically 60% of stuff will happen within a bell curve, whatever it is. If you look at things like clothing, right? Clothing in men's clothing will come from a size 24 up to a size 48 waist in jeans, for example. You will find 60% fall within that area. There will be a small amount that are 24s, a small amount that are 48s, but 60% on average will fall within the other sizes. Trading is the same. 60% of the time will have a candlestick that has a wick to the upside or the downside. It's an instant edge. How big that wick is falls within the outliers. Yeah. So all this strategy is doing is saying, if we've had a bull day, we're probably having a bull day because the bulls are in control. But it's unlikely the bulls are suddenly going to go bang and it's only going to be bull price action today. We're going to get movement. Yeah, so that's what it's doing. So there you go. So that one hit target. This day's not over yet, but it looks like it's going to be a bull day. So it'll probably start to sell. There we go. So we sold there. That was the low. That is a 38% retracement, and basically it took you out in the swap. So that made money in 2 hours, but that's not a typical day. Right, big bull day. So we sold it. It retraced 38%. Remember when we were going through yesterday, level indicators, and how I said Fibonacci works always on all time frames. Yeah, it is a self-fulfilling prophecy in the fact that markets move with uneven order flow, which creates market structure. If market structure exists, there will always be a pullback. That pullback will be a random pullback based on the volume of orders that needs to pull back, somewhere between 38 to 61.8. And it's always that area. And this is where the Fibonacci ratio is. It exists everywhere. It exists in the rings on trees. It exists in the seasons. Fibonacci is a mathematical calculation of probabilities that just plays out everywhere. And this is all this strategy is doing, is assuming that if that has happened, that is going to happen, which it does the vast majority of the time. So the edge is there. The problem with the strategy is if you get a day, hopefully today, where you do not get to that, what do you do? Yeah, so this then turns into a position trade. So that day we bought it, we didn't get the 38 pullback because we had a bear day followed by a bear day. Yeah, so we've now got a 2 down day, and this is another strategy we're going to look at hopefully as well, is the 3 down day strategy. Yeah, after 3 days in a row that are down days, it's unusual for you not to get a pullback. So this then takes advantage of the 3 down day strategy, and all daily strategies you'll find are interlinked and do something very similar. But so we've taken another long there, and you see we're not targeting the 38 retracement now. There's no TP there. Yeah, we've left that old TP up in place, but we're not going to target that TP because if we get out on that TP, we've still got a problem. This trade isn't closed. So what we're going to do now is we are just going to wait for price to pull back to a break-even point or a small profit. So I think in Phil's strategy, he said we're going to now measure that to that and take a 60% retracement of it. Yeah, but the easiest way to do this is just to watch and monitor price, and if price gets back to a break even, shut it, because the trade's wrong. Look at the strike rate. Yeah, it's high. So when we're wrong, there's a higher probability of that pullback happening. So we'll scrap that one and we'll just take those. Yeah, so that's the logic that I've programmed in. I've actually programmed in a $10 or £10 or whatever buffer, which is going to pay for commission and swaps and spreads, or commission and spreads. Yeah, so it pushes down. We've got another down day. So we're now in a position trade for 3. So now we've got another trading strategy, which is a Larry Connors strategy called the 3 down day. Yeah, all interlinked. So the 3 down day strategy means you basically enter on the 3rd down day and you get out on the pullback. The highest probability of a pullback is after a 3 down day move or more. And again, I've tested all of this, 3 day, 5 day, 7 day, 10 day. All that happens is you get less trades and the strike rate goes up the more the movement happens. That's all that happens with things like oscillators. Yeah, the 80-20 level has a higher strike rate than the 30 than the 70-30, has a higher strike rate than the 60-40. The more extreme you wait for, the more probability of movement back. Taking a 100 ADR mean reversion is not as good as taking a 200 ADR mean reversion, except you'll only get 200 ADR mean reversions 3% of the year. You'll get 100% mean reversions somewhere around about 48% of the year. Yeah, so strike rate just changes. So this is now putting the odds in our favor. So we're just going to wait and see if we can get out of the trade. Bang, done. So at 9 o'clock, we looked at the P&L and the P&L was positive. Let's get out. Done. Yeah, start again. We got a bull day. So now we're looking for a pullback. Didn't hit. We've got another bull day. So we're now on a 2 up day. So we short it again. 3 up day, short it again. 4 up day, short it again. So now we've got 4 trades on. So this is turning into a normal position trade, isn't it? But the difference is we've got nothing to do. All we're doing is we're entering every day and then we're shutting our laptop and we're coming back. And then we're going to have a look at 9 o'clock tomorrow. Yeah, and see what's happening there. So now we're on a 4 up day. Go to a daily chart. Not often you get 4 up days. Something's changed. Something's happened basically. So there's 5 up days. 6 up days. Now this is something I need to address spacing. That I don't think should be taken. I think we need to have some spacing between the entries. Otherwise, you've got the potential there to go into an accumulation and just take a load of trades, which is fine if it drops. If it doesn't drop, it's not going to be good, is it? So there we go. So we've moved up into what 5 days up, 6 days up, out. Yeah. So look at a daily chart. Let's go over here. You're going to get the odd one. This is a New Zealand dollar pair, which is obviously not quite as good, but they're more trendy when the New Zealand dollar goes into a loony move, isn't it? But you don't often get, and this is where the 3 down day or 3 up day strategy comes from. And again, it's more stock based. You don't often get more than 3 to 5 days. I'm looking at an exact example of where the opposite happened. But what happens afterwards? You get the pullback, yeah? And what is the pullback? Let's stick a fib on it. I'm not going to give out any prizes. 38%. Yeah, it's Fibonacci. It plays out all the time. Every move has a minimum of a 38% retracement. Every market structure move, every trend, every range, if it's not going to do that, it's going to double top. It's going to pull back 38. It's the magic number. It always is. Always has been. It's a self-fulfilling prophecy. So there are days where this isn't going to work, but what does the market spend its time doing the vast majority of the time? This. 80% of the time, the market spends range bound or in tight channels. Yeah. So 80% of the time, this strategy has an edge because it's a mean reversion strategy. So it's a really nice one because it uses Fibonacci retracement, which we know works. And it uses daily entries. So it's a daily time frame strategy. The fact that we're executing it on the hourly time frame is just for the purposes of the EA, because the EA, to enter at 9 o'clock, it needs to have a 9 p.m. candle. That's literally it. So I can't use the 4 hour time frame because there's no 9 p.m. candle in the 4 hour time frame. So that's why I'm running it on the hourly. But that's basically the strategy. You're going to get into multiple times, and also I've built the logic in here that every candle close it checks the P&L. So it checks at 9 o'clock, and if we're in profit it takes it. But and this is it for multiple positions, but I've also built logic in that it checks every hour. So if we get a news event during the day that takes us into profit, I'm having it. Yeah, we're out. So now we'll sit there in profit, having banked that, and we'll wait for 9 o'clock. This is likely to be a down day. So we'll long it. Yeah. What is this also? ADR. So now you're trading an ADR reversal. Yeah. So there's a double ADR day, which we've just had on the Swiss. This is the problem we're getting in too tight. Look, you're going to get, this is where the EA is not quite right. You're going to get in too tight sometimes, which is going to make it hard to get out of because you're not spacing your entries. You need to make sure that if we have got a trend happening, you're going to not get out of the trend. This is where you're going to get that 30k drawdown. I didn't see what the number went up to. 10. So we've maxed out at 10%, 10k drawdown. That is obviously because there's way too many orders going on at the same price points. Look, so it does need adjusting. You know, you got all these trades happening at the same level, which, you know, you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trades there within an ADR. It's wrong, isn't it? So, but it doesn't matter because it got out. It just, you wouldn't do that in the real world, would you? I think Phil said, and again, I wasn't quite sure on the logic behind it, but he said he waited £80 or $80 between trades. To me, it makes sense to use ADR, a percentage of ADR. So if it's too close to the previous entry, don't get in. Yeah, because you can't use £80 as a monetary value because the monetary value is going to be different on each instrument based on what the instrument is. So So that's it. Can we have the EA? Well, yeah, if we get it working. It's got to be finished properly and done. But yeah, I'll have to give Phil a cut. But for testing, it's not ready for testing yet. As you can see, it's got problems. Look at that. It's a problem. It is a problem and it's not a problem. You know, this is the thing. It's a problem, but as I've just shown, it generates, you know, very big gains. So, but it also blows accounts. Try it on gold. It's not good for gold. Gold is a trendy beast. Time's up. But do you see where with the daily time frames, your strategies and your decision making is much lower, and there's hundreds that, you know, this strategy that Phil's come up with is very similar to many other strategies. ADR reversals for a start. If you just took one trade a day on an ADR reversal, it's pretty much the same thing. So you can replicate this sort of thing with a position trader EA to a certain extent as well. There you go, blown. So there are problems with it. Yeah, so it needs much more thorough back testing. So but I will do some work on it and do some permutation testing on it. But it's, you know, it's got a lot of potential. But it's no different to most day trading or daily time frame strategies. Why can't I grab my window? Okay. Most daily time frame strategies basically will literally just look at the charts once a day, and that's the key to them. It stops over trading completely. Yeah, and it lets the market do its thing. And intraday, and this is where everybody goes wrong on small time frames, and especially with stop loss based strategies, you get into the market and you go, that looks like a good short. The market goes, yeah, it is a good short, you're right, but that is why you're wrong. You lose money because the intraday movement stops you making money. Your decision making is right. If the market pushes in one direction for 5 days on the trot, you hit the short button. If it goes 7 days on the trot, it will come down. But the stop loss is the thing that kills the strategy. When you trade daily time frames without stop losses, with small risk, the worst thing that can happen is you have a day that goes against you. The next day it could come back down. Yeah? Like that. This is an hourly time frame. But if it goes up 2 days and then down 2 days, and you've got in on the first day, you've got an exit with a tiny loss. If you're trading intraday, you'll have had 500 signals to tell you to do something, and you'd have lost a fortune. It completely strips out the overtrading aspect. This is why, as a trader, you don't find me looking at 5, 15, 30-minute charts. I'm looking at hourly charts. I'm looking at 4 hourly charts. I'm one step down from there. I'm mainly focused on the 4 hour because I don't want to see all the crap. A news event yesterday was a prime example. Someone contacted me yesterday in Discord who's in US dollar CAD short. And as soon as the news came out, they contacted me and were like, I'm going to blow my account. This is ridiculous. Panic, cross, angry, you know, usual stuff. And I said, just wait and see where we close, because we've been rallying now for so many days. It's unlikely they're going to sustain that because we didn't get positive news on the CAD. What we got was neutral news. Neutral news after a rally means there's no reason to do that. Yeah. So within an hour, we were back to where we started at the news. And then an hour later, we got a bearish engulfing in. And everybody in the ICT world is going, stop run, stop run. Yeah. everybody in the price action reading world is going 3-bar reversal, wherever you, but if you wait, that's where it opened, that's where it closed. What did we realistically do yesterday? A small candle followed by an indecision candle, which was an inside bar followed by a slight bull bar. Today, if this closes down, what have we got? It's actually a 4-bar reversal, but it's a reversal pattern. Yeah, this panic is caused by intraday trading. News has nothing to do with daily trading, really, because whatever happens intraday, if you get in, how many times have we seen A-shaped recoveries happen intraday or over 2 days? Yeah, none of that happens on the daily time frame. It's disappeared. Look at yesterday on the US dollar CAD. Yeah, what's that? Resistance. Yeah, it's not panic, it's brilliant. Look at that whacking great wick. 50% of yesterday's movement was bearish. So yesterday we had a 50-50. Yeah, we pushed up twice as far, and we got pushed back. Where did we get pushed back? The same place we've pushed back for the last week and a half. Yeah, we're stalling here. It's good, but it's all filtered out. RSI on the daily, that was your short. 1, 2, 3, 4, 5, 6, 7 days. You're still in it. You haven't gone anywhere. But if I'd have entered short on the daily on that signal, I'd have been out there. Done. Yeah. So see how daily it just slows your entire life down. It's a beautiful time frame, but you're just not going to get the volume of signals. So getting in big is something that is worth doing, but you have to use a stop loss with it. So if you're going to get in big, you've got to get in big with a stop, and you are going to get stopped out. The problem with getting in big and getting stopped out is by the time you get stopped out, that signal is usually gone. Look at that beautiful bearish divergence. Yeah, it's just, you know, there's a million ways to apply risk, and this is what testing is all about. So if you go back and look through your charts on the daily time frame and look for opportunities, for example, using RSI 80, that's debatable. One of those candlesticks, you'd have got the signal to short it somewhere in there. Yeah, you would have got, I mean, this is the thing, you'd have got an entry, let's call it that candle there. That candle there is probably too close. That candle there, yes, you'd have had an entry there, you'd have had an entry there. There's no entries there because don't forget we're trading intraday. We're not trading intraday, so there's no signals. We're looking at the close of the candle. So you've got one entry, and then take your pick. You entered here on an 80-20. There's your signal. That's tricky. One of those would have been an entry. So it's either there and there, or that's your first one. Probably too close. You definitely would have taken a trade there. You know, you're back out here, aren't you? But, you know, where I got in, and look at my scalings on this. 5 trades. Daily time frame, you're not taking 5. You're taking 1, maybe 2. Not sure on those 2, depends on the signal. But let's call it worst case scenario. 1, 2, 3 out. Not 1, 2, 3, 4, 5 out. So everything's just reduced in speed. Similar sorts of trades though, still mean reversion. Yeah. Does that make sense? So we'll I will get the other this is running into a bit of a, I had this planned when I thought I had all my EAs that I'd built to test all these strategies available, and I haven't. So it's turned into this should only take a couple of days and we'll whiz through all the strategies into I've got to rebuild all the strategies. So we're going to have to sort of dip in and out of this, I think, a little bit. But what I'm going to do today is I'm going to try and do a bit more development on Phil's strategy and come up and try and get it into the Swiss Army knife. Unfortunately, because the way Swiss Army knife EA works and the way it uses risk and entry, the way that this works is just not fitting in with that. So I've got to kind of do some shoehorning. But I'd like to test timed exits on this as well. And I'd like to test a kind of a trailing stoppy type exit on it as well, to see if it's got an edge for getting you in on reversals. But I think the whole edge of this is the intraday movement, this one specifically, rather than sort of trying to get into trends. The 3 up day, 3 down day, I call it the 3 up day, 3 down day strategy, but actually I found it much more successful with 5 up days. So the 5-day strategy, which I think I've got actually, did I build that into the Swiss Army knife? I think I might have done. Yeah, so this I'm not sure I can trigger it, but it's the in a row strategy, basically. I've called it in here, but it's basically trading 3 days in a row. I'm not sure I can do it on this version, but let me have a look. Might be able to test this now, so I'm going to go 5. Try this on the daily time frame. I don't know if it will work on the daily time frame though. We'll see. No, it does. So this uses a stop loss as well. Yeah, it's not going to work. This isn't a strategy. It doesn't use the stop loss with this particular strategy. I need to figure out. I need to just look up the rules again. But I can do some of these very easily with the Swiss Army knife, so it should be fairly quick and easy for me to chuck them in to the Swiss Army knife and to test them. But I've got to look them all up again, which is annoying. So, but any questions on that so far? How about a TP at an opposite H4 reversal alert? With what though? With Phil's strategy, with the whole edge of Phil's strategy is that we are looking for this, aren't we? The strategy is that we are going to get a wick on a daily candlestick. Yeah. Market reversal alerts aren't good TPs. This is a mean reversion strategy. So targeting a reversal alert miles and miles and miles away, you're basically saying, I'm hoping this is the bottom. I'm going to get into the trend right up. That's going to happen sometimes, but more often than not, it's not going to happen. Position trading, you can't really target that way. You need to target levels with position trades because you need to adjust your levels as well. But yeah, it's got, as with all strategies, there's always an edge until you find out where the edge fails. That's what I'm trying to find. Yeah, and that's what strategy testing is all about. The strategies I found on the daily were all pretty good, but they all had stagnation. They all had periods where they don't work, but they didn't give me any greater edge. And this is the thing, that through my trading career, if you want to call it that, I have been striving to find something better than what I do, and I haven't. This is the thing. I find lots of things which are the same or similar, but if you find another strategy that is going to give you a similar result, what you're doing is you're just getting rid of the same thing and replacing it with the same thing, but you're adding more learning in. If you get a strategy that works and then you test another strategy and it gives you roughly the same return with roughly the same type of trading methodology, what's the point in trading it? Yeah. And this is what I found with daily strategies. Most daily strategies don't use a stop. They use either a timed exit or a monetary exit. Position trading uses no stop and it uses a monetary exit. So daily strategies that I've discovered that are profitable are pretty much what I do. Yeah. So if I add those into my portfolio, I'm doubling my risk because they're taking similar things. An ADR and an RSI extension is the same as an RSI 2 extension in a bull move. I'm taking an RSI 14 when the RSI 2's got in a couple of times. I'm taking the same trade on the same instrument in the same direction, a different price, yeah, but I'm looking for the same thing to happen. The profit take move to work. And that, you know, this is what I mean. The RSI 2 strategy works, but it doesn't work any better than position trading on the 4-hour time frame. Same thing. So, but easier to manage and less discretion involved in dailies as well. But there is discretion involved in drawdown control with all strategies that use position trading. So again, as I've spoken to Phil about how do you get out of drawdown situations, you've got to use some discretion. And the thing I like about that strategy is the strike rate most of the time is high. So if you've got one instrument that you've stuck in drawdown on, yeah, don't know what that one is, but there's trade there as well. So, you know, I'm just circling the winning trades here. Yeah, pretty bloody good, isn't it, from a strike rate perspective? But if, let's say you're trading the Euro CAD here, and you've been 1, 2, 3, 4, 5, 6, 7, 8. Got 13 days of profit. Yeah. If you're stuck in drawdown on something for 5 or 6 days, you got a hell of a lot of cash in the bank to deal with it. So then this is something that is going to have to be live tested. But from a portfolio perspective, the run up on your profitable trades, as long as you've got diversification in the instruments that you're trading and they're not doing the same thing at the same time, which is just the pick of different instruments that aren't correlated, you know, you should hopefully have a load of money being banked as something is getting into trouble, which gives you the opportunity to use this to even the books out. The times when everything is doing the 13-day runs, you're just going to be killing it, aren't you? So, but it needs to be proved. So we'll see. Right, I'll leave it there. 1:30. Yay, another hour and a half. I almost managed to keep it into an hour, but this is because I didn't plan this one properly. It was just like kind of off the cuff a little bit. But yeah, so there we go. So that's daily strategies. We will do some more on it. Tomorrow, it's a similar sort of strategy. So tomorrow, and I might do this every week. Tomorrow, I'm planning to have a pretty much open Q&A type thing. And also we'll look at some more strategy development stuff. So whatever I manage to get done today, basically. So it's quite nice to have a day where we just don't do an awful lot and we just look at stuff, talk about stuff, come up with ideas, and that sort of thing, and look at how things are progressing on other things. So I like this. Might use it for aggressives. Yeah, you can use it for aggressives if it works. You've got to use a stop loss on an aggressive drawdown control trade. I mean, most of the time with these, I mean, I'm literally just looking at this chart we've got on here. Most of the time, the profit is straight away. But when the profit isn't straight away, in that case, where it pushes down, you're stopped out on your aggressive drawdown control position. And then you go, okay, well, I'll take another one. Wherever you put your stop, you're stopped out on your aggressive drawdown control position. The one the next day worked. So, yeah, I mean, you could look at it that way. Yeah, it's an option. Again, you know, there's no right or wrong. The whole purpose of aggressive drawdown control is that you are in a trouble and you need to get out of that trouble. The way you get out of that trouble is by taking a large risk to get you the exit. This could be one of those options. I'd much rather take it when we've had a big down day. Yeah. Yeah, so I'll do some more testing on it. I need to build out the EA basically so that it's but all development is, when you're developing a strategy, what development is about ironing out the problems. The immediate problem I see is these 3 trades are taken too close together. So I need to iron that out. So I need to develop code to space trades, which means I need to introduce ADR, which means I need to code ADR into the EA, which it hasn't got at the moment because it doesn't need ADR. So there's stuff that I need to build in and then test it. And this is why testing and strategy development takes such a long time. You run something, you go, holy crap, what a P&L, what a profit curve. And then you look at it visually and you go, yeah, but that's because it took 3 times the risk to get that exit. What if it had done that next and not that? Yeah, you always look at the what if. So yes, it looks great, but what if? Because the market will give you the what if at some point. Yeah, like I said yesterday to Andy, I think it was in the Discord channel, the market will stay irrational longer than you can stay liquid. And it's proven that to me many times. Oh, it can't go up anymore. Bloody can. And it will. If it wants to, it will go up until it doesn't. Think about how precedents are made. Yeah. How records are broken. Yeah. Records are broken because it achieved something more than it did before. We've never had more than a 9-day run on the pound US dollar. 12 days later, boom. Next time we get a run of 9 candles, you go, we've never had a run more than 12 candles, 14. Oof. The precedent is always set by the markets remaining more irrational for a longer period of time than you've ever anticipated or seen in the past. That's just what happens. Yeah. All-time highs in the stock markets happen because it breaks the high that we had before. Often, when you get to an all-time high, it will bounce at it. It will continue to do that until it doesn't. There's a new precedent. So everyone that says, you know, look at the 150 level on the US dollar yen. They always hold it at 150. They used to always hold it at 150. Yeah, I agree. They used to do that. They don't there. Yeah, now 160 is the intervention level. We're above 150 now. So what do? When it gets to 160? Yeah, see, 160. They never go above 160. 2 years later, we're up at 175. The market will do what it wants. You don't have control. No matter how many times you've gone and looked at this thing and said it's never got above 90 before, it'll get above 90 and it won't stop. Yeah. So you've always got to, when you're doing a strategy development, almost break the strategy by going, right, this works really well, but what I'm going to assume is in the future, this is going to happen. And you program into the EAs or your strategy test, what if that would happen? Holy crap, I would have taken 50% drawdown on my account. Yeah. You have to, at some point, cross your fingers, yeah, and hope that we don't get another COVID. Because if we get another COVID, there's a good chance it will go further than it did on the last COVID. We don't know what will happen, but you have to factor all these things in. So strategy development is, for me, about finding a strategy that has a good looking edge. And I've found hundreds of strategies like this over the years. But when you actually play them out on multiple instruments, you find they will only work on certain instruments, which is not a problem. You just make sure you only trade them on those instruments. ADR reversals don't work very well on the Swiss and yen pairs. They never have done. However, I still traded the ADR reversals on them. But yeah, we will. It's not the question, but if, but when. Mark my words. We will what? Have another COVID? Yeah. I'm sure we will. I've had this cold thing, whatever it is, for the last 2 weeks now, and I keep getting better and worse and better and worse. You see me coughing. I've just done it now because I said coughing, but I'm still coughing now. This thing hasn't left my chest in 2 weeks. I've done a COVID test. It's not that COVID, but it doesn't mean it's not the new COVID because the test doesn't do the new COVID, does it? It's probably a different strain which we don't know about yet. And all of a sudden we're going to have another pandemic. When we do, the markets will collapse. Yeah, whatever strategy you've got, it won't have seen that before, and it will fail. Unless it happens to be a strategy that went short at the exact time the COVID drop happened and you didn't have a TP on it. Well done, but that isn't a good strategy. That was just luck. There's a 50-50 shot, you're in the right direction. Swiss franc. When the Swiss franc peg was removed and they moved it 1,000 ADR in an hour, yeah, there was a 50-50 chance you were on that. I was. Yeah, but I also couldn't have been. Yeah, it's blind luck, isn't it? You know, when the war kicked off in Ukraine, if you happen to be longing oil at the time, well done. If you happen to be shorting oil at the time, unlucky. So 50-50. But you've got to factor in what would happen if that happened. Yeah, so, you know, this is what it's all about. This, you know, I showed you the equity curve and it looked amazing. Now I've shown you what happened during the equity curve. You're probably looking at this and going, as I am. But we can eliminate a lot of this by not taking 4 positions there and taking 1. Yeah, there 4x the drawdown that we would have had if we'd have taken 1 position. There's no reason to take 4. So, you know, this is what we've got to do is look at it in a more logical way. And this is only testing over a year as well. Definitely doesn't work on gold. I know that for sure. But anyway, I will work on it. So I will be back tomorrow, same time. And tomorrow we'll just do a very relaxed session on whatever. I'm hoping to get more work done on this today and on the other daily strategies so that I can do some more looking into them tomorrow. If I haven't managed to for any reason, my car's in the garage unfortunately today because the washers are blocked. So I've got to go and get that at some point, and it's 10-12 miles away, which means I've got to go and get on a train and get off the train, get a car and come back. So that's a good hour or so of my life that's disappearing at some point. So I'll see how much I can get done. But anyway, all right, so have a good day. If you need anything, let me know. I'll be in Discord. And obviously, if you've got any questions and you're watching on replay, comments. And I'll be back tomorrow, same time. And obviously, we'll see how everything goes this afternoon. Be aware of all the PMIs today. Yeah, it's going to be a busy one this afternoon. So movement planned. All right, have a good day. I will see you guys next time.